Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending October 17, 2025. So the title of the review this week, I think it's a reuse for this title. It's All That Glitters. Of course, it's a reference to gold. So the gold prices are going to the moon, it seems, these days. What's driving this? Is there still some room for gains? Which do you do with your portfolio if you own gold, and more importantly, if you don't directly own gold right now? We'll take a look at that. But this week we've had an interesting backdrop in the market. We had a sell-off on Thursday. This morning, as I'm recording this Friday morning, markets are also down by, I think, about 1% left and right on the future market. There are some risk factors that seem to be creeping back into the market. So those are new, old risk factors. We'll get into them in a few minutes. But if you look at the returns on the week, well, good things happening for the bond market. So risk-off sentiment is beneficial to bonds here. You might be looking at that to say, what's he talking about risk off? I mean, 2% on the week on the TSX, 1.5% for the S&P 500 in Canadian dollar. Said it was positive at the beginning of the week because we've had maybe a calmer tone from the US versus China. More on that in a minute, but it seems to be still a very live thing. So it could be spooking the market at any time. We have the VIX, the fear index, that is sitting at about or above 20 right now. So it's some nervousness in the market. But the highlight of the week again is gold. This is not a typo. Close to 8% on the week for the price of gold, 65% year to date. So good things are happening there for any gold bug out there. So maybe going first for the risk factors. Again, these are new, old risk factors because there's nothing here that we haven't discussed over the last, let's say, 2 or 3 years. If we start on the left, China and US again. So last week, what spooked the markets was that China expanded their rare earth restrictions, and they're targeting defense and chips users. So let me read here from a few news outlets. I have some notes here, but last week China came out with an announcement that said that they were detailing sweeping new curbs on its rare earth exports. And under the new rules, and I'm reading here from BBC just to be fair with the source, foreign companies now need the Chinese government's approval to export products that contain even a tiny amount of rare earths and must declare their intended use. Of course, this didn't sit well with US President Donald Trump, and he right away threatened to bump up tariffs by 100% on China because of that. And now they've been talking a little bit. And now what we have is a comment from Scott Bessent, the Secretary of the Treasury in the US, saying that, well, Trump is ready to meet with China's Xi in South Korea. This is on October 31st and November 1st, as was initially planned. And then they should be talking like grown-ups and try to figure this thing out. So far so good. The market seems to be satisfied with this, saying, all right, there are some threats on both sides, but they will be talking, but it still remains a live risk factor. What's new this week is what I have on the right here. Jamie Dimon, the JP Morgan CEO, very influential person in the world of finance, when he was addressing some recent issues in the private credit market, saying that when you see one cockroach, usually there's more to come. Well, this is kind of spooking the stock market here because following his comments, we've seen not just private lenders having some issues, but a few regional banks in the US. What I have here is Zions Bancorp that had some issues this week. They disclosed a loan loss provision of $60 million in the next quarter, but they're saying this is an isolated incident, nothing systematic there. Then on Thursday, you had Western Alliance Bancorp saying they revealed that they had filed a fraud lawsuit against the borrower. And they said again, they don't expect a material impact. This is an isolated thing. But market is, of course, market has been going up very solidly since the lows of April. So it's normal that after a few months like this, when you have a few risk factors coming up, at some point profits are taken. That leads to some volatility in the short run, and usually that creates a new buying opportunity. So we're not worried at all here about the sustainability of the market rally. Correction of between 5 and 10% could always happen. Usually, these are buying opportunities, but there's nothing here that makes us think that there's something that's systemic here for now. So if we change our views, we'll keep you posted over the next few weeks. But for now, volatility is just normal at some point, could create a buying opportunity here, but this is life in the markets. Now going to gold, well, or is this going to the moon? When you look at the chart here, it does look like it is going to the moon. It is going parabolic. We've been in this position directly on and off, but mostly on since late 2023. Our reasoning was central banks are buying gold. The retail sector needs gold with all of the geopolitical risks that is floating around. There was many reasons to be into that trade, and it's been kind of a rotation of reasons. This is what makes it such a solid and strong trade. But now we're closing into 4,500. Full disclosure, we have sold some of our positions starting at 4,000 last week, and since there is no such thing as an equilibrium price for gold, because it's a different commodity than say oil, where if the price goes up too much, some point supply will be flooding the market and prices will come down. For gold, you don't have this dynamic because the supply of gold is pretty much fixed, because annual production is tiny compared to the amount of gold that is available in the world. So the next milestone for us is 4,500. We'll reassess our plan there, but it seems that it's now very much a momentum kind of trade rather than a fundamental trade. And what's behind the recent push? The next charts here paint the picture. Over the last, let's say, 5 years, I would say, the share of the US dollar within the central bank's assets reserve has been going down. And central banks, they need assets on their balance sheet because they need to put together market operations. So sometimes they need to defend their currency. Sometimes their currency is too strong. They need it to weaken a little bit. So they need to buy and sell assets on the markets just to go about with their operations. And the lion's share of their assets, as you can see in the chart on the left, the gray line, typically has been the US dollar because it's the reserve currency. There's a bunch of other currencies that are held as well, but as you can see, it's not the yuan that is taking the US dollar spot. It's not the euro, it's gold. Gold is being accumulated by central banks, and they're buying that instead of the US dollar. So this is a very strong tailwind for the price of gold. That explains, we think, the lion's share of the move or the trend higher that we've seen over the last few years. But now, over the last few weeks or months, it seems that it's a chart on the right that is starting to drive the show. It's the retail participation that is starting to, let's say, run after this theme, and it's pretty much now a momentum kind of trade because of that. So these are the ETF, the total known ETF holdings of gold. So exchange traded funds. Mostly retail, but institutional players like us, for example, we could be using sometimes an ETF to hold gold. We tend to use futures more, but if depending on the size of the product or the manager, sometimes they use ETFs as well. So this is an accumulation spree that we've seen here that makes it a momentum trade. So if you were in this trade, if you already have gold in your portfolio, like a direct exposure to gold, taking profits is never a bad idea. This is what we're doing. We're selling on strength. So we would recommend the same thing. If you're not in that trade, there's always a place for gold in your portfolio, but go cautiously because it's always tempting to go overboard when you see a chart like this and try to extrapolate that we're going to be going to 5,000 and 10,000. We don't know exactly at which, what's in the future. And when we have such strong movements, sometimes, not often, that leads to short-term reversal. So be careful with that. But also make sure that you think about your whole portfolio, because if you have Canadian stocks in your portfolio, well, within the TSX, the weight of the gold producers is getting pretty high, and this is becoming a solid driver of TSX performance. So directly and indirectly, you are exposed to the gold theme if you own Canadian stock indices in your portfolio. So take all of those things into consideration. So right now we're still riding this, but taking profits as we're moving higher. We'll keep you posted if we change our view. But again, this is a time for caution. Here, the worst mistakes are made when you think that everyone's invited to a party and you're not, and you're buying at the top. So be careful here not to go overboard. But again, gold plays an important role in a portfolio. And again, it shows that it pays to own some in your portfolio. But let's say 1 or 2%, not 10-20% here. What we'll be watching next week, last week we mentioned that the next budget coming up on November 4th would be important to, let's say, the government wants to be contagious for the private sector to start to invest alongside the public sector. Well, one chart that we showed was the Bank of Canada Business Outlook Survey, which is pretty much flat for now in terms of investment intention. So we'll have a new reading next week, very important one before the budget. So we'll be focusing on that for sure. We'll have CPI inflation, which should be down on a monthly basis, and retail sales in the US. Government shutdown, but we should have a CPI inflation number. The reason is that you cannot, if you're a government, not have an inflation number on a monthly basis, because this is used to index the social security plans. So you need to have a measure of inflation. So they brought back some staff. The quality of the data might be disputable, but we should have a report next week, and we'll have the S&P Global PMIs and the University of Michigan Sentiment Survey. So that wraps it up for the week. Always a pleasure to serve you. If you appreciate the content, please share, and of course, come back again next week.